Best Guide for Stock Market Value by www.options-trading-education.com. Well-run companies with consistently profitable business models make money and their stock prices rise over the years. The collection of businesses that is the U.S. economy generates a gross domestic product. Investopedia discusses why the gross domestic product, GDP, is so important. The gross domestic product, GDP, is one of the primary indicators used to gauge the health of a country's economy. It represents the total dollar value of all goods and services produced over a specific time period. You can think of it as the size of the economy. Usually, GDP is expressed as a comparison to the previous quarter or year. For example, if the year-to-year GDP is up 3%, this is thought to mean that the economy has grown by 3% over the last year. Because stocks increase in value as company earnings rise, there is a direct connection between the value of all stocks, the market, and GDP. The most famous investor in America, Warren Buffett, uses the ratio of total stock price to GDP as the best guide to stock market value. In this regard, stocks may be overvalued according to CNBC. Buffett believes that when the ratio of total market capitalization is too high, like 125% today, that the market is overvalued. The current market cap GDP ratio of nearly 125%, resulting from paltry GDP growth less than 3%, could be problematic if you subscribe to Buffett's mantra. The ratio is now the highest it has been. It was even a little higher in 2015, since the market went over a cliff in 2000, when the ratio had actually been 151%. As stated in his essay, for investors to gain wealth at a rate that exceeds the growth of U.S. business, the percentage relationship line on the chart must keep going up and up. If the ratio gets too high, Buffett says, you're playing with fire. Investors are chasing returns and not value. Buffett and his company, Berkshire Hathaway, are sitting on historically large amounts of cash. This is because they do not see good value in the market. Holding cash lets an investor take advantage of opportunities when stock prices fall, which could be the next step for an overpriced market. Long-term investing and cashing in on opportunities. Buy and hold investors like Buffett do not think that you can profitably time the market again and again over the years. They select stocks whose business models are clear and easy to understand and are likely to continue creating profit for years and years. The reason that Buffett and those like him avoid high-tech computer stocks is that in a fast-moving tech world, it can be hard to predict winners and losers 10 or even 5 years out. On the other hand, Buffett says he can better predict how much someone will pay for a Snickers bar or a bottle of Coca-Cola. Watch the GDP and see if it starts to accelerate, and if it does, jump in and buy good stocks that you understand. For more insights and useful information about options trading, visit www.options-trading-education.com.